All right, let's jump right into it. Welcome to this explainer. Today, we're unpacking a really massive transformation that's happening right now in the world of global supply chains. To help us wrap our heads around this, I want you to picture a corporate comic book hero. Let's call him Logi, the logistics hero. Now, Logi is fighting a high-stakes, everyday battle against this huge, invisible enemy, trapped working capital. For decades, businesses have just been locked into this incredibly rigid system that literally suffocates cash flow. But Logi is armed with a brand new, highly sophisticated weapon. Today we're going to see exactly how he uses an AI cash flow engine to absolutely smash the old ways of doing things and free up capital across the globe.
Okay, let's dive into this. Think about it. What if payment terms weren't just this agonizing waiting game? Historically, supply chain finance has operated under incredibly inflexible structures. Traditional payment terms, like waiting 90 or even 120 days just to get paid, have somehow become the totally accepted industry standard. But there's a fundamental tension here. You have buyers who want to hold on to their cash as long as humanly possible to preserve their own liquidity, right? And on the flip side, you have suppliers who desperately need those timely payments just to keep the lights on and keep operations running. This waiting game creates a very dangerous liquidity vacuum that strains business relationships and absolutely kills operational efficiency.
And you might be wondering, just how dangerous is this vacuum really? Well, consider this staggering statistic: 30%. Research indicates that extended payment terms tie up approximately 30% of a supplier's annual revenue in outstanding receivables. Think about that for a second. Nearly a third of what a company earns in an entire year is just sitting out there, trapped, creating these massive cash flow pressures. The buyer might be enjoying an improved cash position, sure, but the supplier is left gasping for air, forced to somehow manage cash flow gaps that can sometimes span multiple fiscal quarters.
And the thing is, when a cash crunch hits just one supplier, it doesn't happen in a vacuum. It cascades down the chain, knocking over the entire network like a dangerous set of dominoes. If a Tier 1 supplier can't get paid, well, they can't pay their Tier 2 supplier, who then can't pay the raw material provider. It's a structural risk factor that creates an incredibly dangerous weak link in global trade. Financial liquidity isn't just some nice-to-have perk. It is the absolute foundation of holistic supply chain risk management. When that foundation cracks, the whole system is at risk of falling apart.
So, that old status quo? It's simply no longer viable. Why? Because of changing market dynamics and some very serious regulatory pressures. New accounting disclosure requirements under IFRS and US GAAP, specifically rules like IS7 and IFRS 7, which crack down on hidden debt, are stepping in. They now require corporate buyers to transparently disclose the exact details of their supply chain finance arrangements, strictly preventing companies from masking bank debt as trade payables. You can no longer just endlessly delay payments to boost free cash flow without regulatory scrutiny. Basically, that free lunch is over. So this sets up the ultimate showdown. Traditional finance operates like what we can call a stone calendar. It's rigid, it relies on fixed net 90 terms, static rules like 2% discount if paid in 10 days, otherwise net 30, and painfully slow manual processing. But Logi counters this with a complete paradigm shift, the AI-enabled instant payment framework. Instead of rigid terms, we have dynamic, data-driven timing. Instead of static discounts, we get optimized, personalized offers, and instead of manual paperwork, we have autonomous invoice liquidation. It reframes supply chain payments from a fixed, boring obligation into a brilliant data optimization challenge.
And the sheer power of this AI framework is just staggering. By deploying neural networks, which combine optical character recognition and natural language processing, organizations are slashing their invoice processing times by 80%. 80%! Cycle times that used to take weeks of manual, tedious three-way matching across totally disparate systems are now compressed into mere hours. And not only is it faster, but these systems also improve accuracy rates to above 95%, which virtually eliminates the friction that historically forced buyers to demand those long payment windows in the first place.
But hey, speed is really just the beginning. Let me introduce you to Logi's actual superpower, the cash discount likelihood, or CDL score. The old stone calendar offered everyone the exact same static discount, which usually failed because it completely ignored individual supplier circumstances. The CDL score completely changes the game. It uses advanced machine learning and predictive analytics to analyze over 80 different data points. We're talking seasonal revenue fluctuations, market trends, specific payment behaviors, the whole shebang. It calculates the exact optimal discount rate that a specific supplier is highly likely to accept at any given moment. Let's move along and see how this builds out in practice, because Logi executes this in 4 very precise steps.
Step 1. Onboard the suppliers and validate their data against trusted sources. Step 2. Correlate that supplier data with massive sets of proprietary spend insights and behavioral history. Step 3. The machine learning algorithm gets to work, reducing dimensional spaces and standardizing variables to generate that unique CDL score. And finally, Step 4, communicate these highly targeted, sliding scale offers through automated marketing, whether that's via email, text, or a web portal. The supplier just gets to seamlessly click and choose the exact combination of discount rate and payment date that perfectly suits their immediate working capital needs.
Now, what's really interesting here is the definitive proof of our hero's success. Just look at the utilization rates. Under the old, static, traditional models, you'd be lucky to hit a 35 to 45% utilization rate because the offers were just blunt instruments. But with AI dynamic discounting generating personalized CDL scores, that utilization rate skyrockets to between 75 and 85%. Buyers are able to maximize their yield on idle cash, and suppliers get life-saving liquidity exactly when they need it most, without having to resort to expensive short-term financing that can cost them up to 15% annually. It's a true win-win for sure.
But Logi isn't satisfied just saving the direct Tier 1 suppliers. He needs to expand the AI shield to the entire network. This brings us to Deep Tier Supply Chain Finance, or DTCFF. Traditional supply chain finance programs usually only benefit the massive, direct suppliers right at the top. DTCFF is a real game changer. It's a mechanism that allows post-shipment finance to flow much deeper into the network. If the anchor buyer's approved obligation can support early payment to their Tier 1 supplier, that exact same commercial assurance can now be pushed down to the Tier 2 and Tier 3 suppliers.
And why is pushing this liquidity down the chain absolutely crucial? Because we are talking about saving the SMEs, the small and medium-sized enterprises that are so often the forgotten links in global trade. These smaller, deep-tier suppliers usually lack the established credit track record or the physical collateral required to get traditional bank loans. But with deep-tier supply chain finance, they don't even need their own collateral. They get to bypass that hurdle entirely by leveraging the incredibly strong credit profile of the anchor corporate buyer at the very top of the chain. This brilliant maneuver keeps these vulnerable SMEs solvent and highly resilient.
So, where exactly is this all heading? Well, we're moving rapidly from mere AI automation to a fully autonomous liquidity future. Advanced platforms are now deploying autonomous agents capable of doing 3 really incredible things. 1, they can predict liquidity needs and cash gaps up to 6 months out just by analyzing market patterns. 2, they can put dynamic discounting on complete autopilot, automatically adjusting rates based on real-time interest rates. And 3, they utilize a real-time AI risk radar. Using unsupervised anomaly detection, the system constantly monitors thousands of data points to flag fraudulent submissions or supplier default risks long before they ever actually happen.
So the crucial point we need to take away is this. We are actively witnessing the transformation of a term problem into a data problem. By breaking the stone calendar and replacing it with an AI cash flow engine, Logi the logistics hero is creating high-velocity digital transaction flows that benefit absolutely everyone. But it leaves us with a fascinating, provocative question to ponder. As AI continues to evolve and achieves complete frictionless autonomy over global capital, will the very concept of fixed payment terms be eradicated forever? What does the global economy look like when cash flows exactly where it's needed, exactly when it's needed, without a single day of unnecessary waiting? Thank you for joining me for this explainer, and I highly encourage you to keep questioning the status quo.